All right. Well, thanks a lot, Edward. Um, yeah, I'm gonna do what I usually do. I am gonna go over the entire year for 2025. Obviously, the elephant in the room is what's going on with tariffs and trade policy overall, and even what their impact is on the economy in other ways. I am gonna touch on that first, make a few comments, and maybe give some numbers for reference. But there's a lot of uncertainty and really the forecast that we're doing right now doesn't, could change a lot in a month depending on what happens, or in 2 months depending on what happens. But that's the cards we've been dealt right now. So I am going to make a few comments on that. I'll go into the U.S. market and say this is where things look like, what the health is right now, and what we currently think how things are going to play out the rest of the year. I'll get into the individual manufacturers again and look at their production outlooks for the year. And then at the end, I'll do a brief 5 year outlook on sales and production. So going to it, I just thought we might as well just bring that right up. All the market and everything that's going on in it. What it always ends up, well, what does this mean for production? Because that's where pretty much everybody makes their money from. So this currently is the North American light vehicle production outlook we have right now. We're saying 2025 is basically going to be flat with 2024. This is showing production by quarter going back to the beginning of 2023, with forecasts for each quarter in this year. And you can see the box at the top. Our forecast for the entire year is 15.44 million light vehicles for all of North America, US, Canada, and Mexico. We did have lower production in the form of year-over-year losses in the second half of last year, and we are forecasting losses in the first half of this year. Most of that, we believe, is related to slowdowns for inventory control. Demand was not as strong in 2024. It started to show some weakness. Manufacturers do seem to be earnestly trying to keep inventory from getting too excessive. Manufacturers on the whole, not every manufacturer was successful at that, and that's leading to even more cuts in the first half at some of them who let inventory get a little bit out of hand. But some of those cuts include cutting excess inventory for electric vehicles. Although inventory for electric vehicles is probably going to rise because we are getting more product coming in this year, but some manufacturers are cutting that. I'll talk about some of these things in some of the slides coming up. But weaker demand for fleet vehicles seems to be a reason for cutting production. And then besides the U.S., we're also expecting generally flat sales this year in Canada and Mexico. So getting to just some comments on the tariff issue, which again, I say there's just too much uncertainty, and obviously it's putting a lot more risk than normal on our outlook for the year uh, in March. Just as a general rule of thumb, it really depends on how high the incentives are, who they're on, what they're on, what the time frame is, the loopholes that might be put into any future changes. But generally speaking, higher tariffs do lead to lower sales and production, or at least that's what our assumption is going forward in this year. There is more downside than upside, I think, to the current 2025 forecast due to all the uncertainty going on right now and the lack of specificity on the tariffs. Besides lower volume, a likely fallout could be if this volatility on trade policy continues, as there'll be some delays, maybe cancellations on some new vehicles or redesigns of existing vehicles that were scheduled in 2025. Just to try to put some numbers to it, which is really tough to do right now. Although the Trump administration did pull back on how far they initially were threatening to go as of March 4th, they did not go through with this, but are saying maybe they will in April. But if they had gone through on putting full tariffs of 25% on all imports from Canada and Mexico, plus 10% on all other countries as they were planning to do on March 4th, but as I said, didn't. And those had remained in place for the entire year. Global data in that scenario would say sales would have been gone down by 1 million units in the US from the forecast of 16 million. So they were saying it would have gone down to 15.2 million under that scenario, with possibly more downside risk to that. As it was, the sales forecast was brought down 200,000 units for now to 16 million. And then under that extreme scenario, and when you're including the impacts on the Canadian and the Mexico markets, production, depending on how fast and how each manufacturer might have reacted to the tariffs, production probably for the year, based on what the forecast is, probably would have been gone down 500,000 to 700,000 units. Put a little bit more, just some reference to what's the tariffs going forward, just for your benefit. Say right now, this is sales in 2024, and then based on the forecast for 2025. In the U.S., roughly 3/4 of U.S. sales are of vehicles built in North America, and just a little over 50% of the sale of light vehicles sold in the U.S. are made in the U.S. 17% come from Mexico and about 7% from Canada. Looking at it from just a slightly different point of view, right, in the U.S. market accounts for about 80% of what's produced in North America. And then just to put some more numbers to it, even though I was kind of hesitant to put this up here because it's, in a way, it's really misleading, because as I'm sure a lot of you have already been reading or seen in the trade press and so forth, you can't just move excess capacity production from one country to another. In most cases, it's not something you can do overnight. In a lot of cases, it would take weeks, months, years. But this is showing, based on forecast production for 2025 and what our estimate is for available straight time capacity in North America in each country. I used what we call available straight time capacity, and that means taking what each plant can do on straight time based on the schedule that it is actually working this year. And by schedule, I mean whether a plant is working 2 daily shifts, Monday through Friday, maybe 3 shifts, 1 shift a day, or some of the variants like 3 crew plans and so forth. But I thought that made it a little bit more of a reasonable or a real number, closer to a real number of what the excess capacity is. But this is showing that in theory, and I emphasize in theory, U.S. plants in 2025 will, based on forecast production for U.S. plants, will have 1.6 million units of unused capacity. If you want to throw in what potentially each plant could do on overtime, it's probably more like 2 million units. Realistically, as I've already alluded to, there are a lot of challenges that make moving that much production to the U.S. from Canada and or Mexico or from elsewhere, moving production from overseas, is kind of unreasonable, at least doing that in the next 2 or 3 years. And then for a lot of other reasons, you probably wouldn't move all that production to the U.S. But production shifts to the U.S. would begin if they start happening, and they probably will. We probably will see some increase in U.S. sourcing if the tariffs stay in place to a significant extent. It would probably be based on vehicles, the few vehicles that are also built in the U.S. that are built in Canada and Mexico, start with them, and then vehicles that are built on common platforms, meaning they're have similar engineering and a lot of commonality of parts underneath the skin, parts and components. Global Data just worked up these numbers recently, so I'll throw them in there. And these are based on on production volumes. They said that pretty much 54% of platform or production in North America, in the U.S., is 54% of that platform of production is of platforms only produced in the U.S. 22% is of platforms built in both the U.S. and or Canada. And that means that 24% 4% of production is coming off of platforms not built in the U.S. But again, these are just numbers for reference. There's a lot of reasons that you need to dive down to, and we could spend a whole 40-minute or 60-minute presentation on going into the possibilities with capacity shifts and why it's not theoretically reasonable to get up to those volumes. All right, getting down and now into the U.S. market, this is where we see where things are now, what the health is, and where we currently are forecasting things to go. These forecasts were taking into account some sort of a tariff implications, even though some of them are from before March. But this table is showing U.S. sales based on the seasonally adjusted annual rates by quarter, going back to the end of 2019, which was right before the pandemic and the supply chain shortages and all that stuff kind of hit in 2020, 2021, and rolled over into 22 and somewhat 23. But we do see sales slightly rising this year, as I said, to 16 million units from just under 15.9 million units last year. We see strong, based on what we're seeing right now, we think the fourth quarter will be quite a lot stronger than the first 3 quarters this year. The tariff seesaw and other potential risks, as I've already alluded to, made a forecast cut to 16 million from 16.2. What's keeping growth from being stronger, especially when you're coming out of the trough that we had from 2020 through 2022, still is overall its affordability is the main headwind to it. But inventory levels, the total inventory level, as well as the mix being somewhat skewed to more higher cost vehicles, plays into it. And then, as I'll talk to a little bit more in a few minutes, there seems to be a pullback in fleet deliveries, which is also probably having a negative impact on production. But getting into that retail versus fleet issue, retail sales, which this chart is showing, and that's basically the sales off of dealer lots to the everyday consumer, and roughly accounts for 80% of the market, so it's the main driver. This table is showing monthly retail sales. The bars are the actual volumes going back to the end of 2019. The line there is showing the rolling 3-month totals. The numbers are showing for February of each year going back to 2020. And then that flat bar, that flat line is just, again, I'm using the 2015 to 2019 period as sort of a default for normal, or are we getting back to that, trying to show, are we at a new normal or getting back to an old normal? But that bar is basically just the 3-month average of all the months, of every month from 2015 to 2019. And you can see to a large extent, we're pretty much back to what we were doing in the pre-2020 era. That dip down in February is more of a seasonal thing, and it's probably going to come back up at the end after we get March volume and we have a full quarter. So that's not quite as bad as it looks, that dip there to 3.134 million over for the 3-month total. The estimated year-to-date retail sales just for the first 2 months of the year are up 4% year over year, and the mix is up to almost 82% versus 79.5% in the year ago period. So then looking at the fleet volume, and fleet is basically the batch deliveries to what are broadly divided into rental, commercial, and government customers. The most fleet deliveries, about roughly 3/4 of them never go to a dealer, so they actually never even show up in inventory numbers. But this is where the weakness has been lately, which is kind of keeping the market from getting stronger and getting more up into the annual 16.5 million rates or higher, or having the bounce back that you might think after we hit those troughs that we did in 2020 through 2022. But more specifically and you can see from the line there, we're still quite a ways from getting back to what at one point was considered normal. But after surging in the 19-month period through the end of 2023, including a 41% year-over-year gain in the calendar year 23, deliveries dropped 6% in 24, and they're down an estimated 9% in the first 2 months of this year. I haven't been able to fully get down to the bottom of what are the real reasons for the decline. It seems to be there's weakened demand from the commercial and the government sector. Rental is basically flat. Rental, though, is also about the biggest portion. It's usually 50% or more of the fleet market. It's also possible that some automakers are deciding to concentrate more on retail volume versus fleet volume because retail tends to be more profitable, at least on a per unit basis. So looking at pricing, and again, really, affordability overall has been the main driver for why volume hasn't been stronger. And I think this gets into a kind of a sub-story or sub-theme that I have, that maybe we might be at what might be the industry is considering a new normal right now, at least temporarily. But this is showing the average price for retail vehicles sold going all the way back to the end of 2018. And then those are the big long blue bars. The small bars at the bottom are the average incentive spend by the automakers each month. But the real line to look at is that line, which shows the percentage of an average retail spend as a ratio to average price. And you can see for a long time, after we hit rock bottom at one point when inventory nearly died out for a while, and inventory started to rebound, incentives started to rebound too, and that ratio started to surge and was growing fairly steadily for a long time. And after undergoing a gradual year-over-year declines from mid-23 through November 24, the average prices actually started to rise and rose year-over-year in 2 of the past 3 months. And that's where I'm kind of getting into. You look at that line then, incentives are still rising by double-digit gains year-over-year, but those gains have slowed. Almost in half of what they were for a long time there, for about 1.5 years. But you look at that line then, that ratio of incentives to price, and it's more or less been flat since November, which makes me wonder if maybe the industry has finally got to a point where they're kind of in the happy place where inventory is versus demand, at least for the time being. You use that ratio, and as I said, it's been roughly flat since November, and it might mean that the manufacturers are kind of happy where they are, and that's why we've seen production slowdowns. There may be other reasons for that, though. So looking at the inventory levels, this is showing, the dots are showing actual inventory by month for 2023, 24, and the first 2 months of 2025. And then the forecast we have for each month through the end of this year. The transparent bars are, again, going back to what we're considering normal. That's the average volume for each one of those months from 2015 to 2019. You can still see we're still well below what was considered normal at that time. But that was in years when we were having sales of 17 million or more. So inventory does continue to grow year over year, but that growth is slowed, and that means the more inventory, the growth slows of inventory, the less likely we're going to see stronger sales growth. The slower inventory growth we've seen, as I've already talked about, is more related to production slowdowns. Sales are growing, and obviously higher sales takes more inventory off dealer lots, but I think the slower growth really is more related to the production slowdowns that we've been seeing, and that implies intent on the manufacturer's part. Staying with inventory, this is basically the same table as the previous one, except it's showing the days supply on hand versus the volume. Day supply acts as indicator, although it's not always perfect. The day supply acts as an indicator of where inventory stands in relation to demand. Based on history, the current day supply indicates that inventory is straining to meet demand. You can see the current day supply, and then the forecasted day supply is still well below what that 2015 to 2019 average is. I kept that at 2015 to the 2019 average, but if you went back 20 years, even 30 years, those day supply averages are would pretty much be where they were. So I mean, this is a real historic change in an historical trend. If my speculation is correct, that the industry, at least for this year, is kind of where they want to be with inventory in relation to demand. But day supply, you can see by the end of the year, is still not going to be back up to where, even close to where it historically was normal for that time of the year. And that means that in theory, and I think it implies that there's still pent-up demand that the industry could tap into if it wants to. But the only way to tap into that is to increase inventory and also make some price relief there, put some price relief into what's on dealer lots to tap into that excess demand. And then this is just the fresh product thing I like to show. It's not a main driver, but I think it has an impact on demand, at least in solid sales years when the economy is going good. This is showing fresh product as a share of total light vehicle sales, and we're just calling fresh product is the first 2 years that a vehicle is on sale, either as an all-new vehicle or as a re-engineered or redesigned vehicles. And you can see the share over the last 3 or 4 years or so is well below what was a trend going back to 2013. And even if you go back a decade or so, but before 2013, that share was usually up around in between the 25 and 30% range. I just want to point out that the 25 year to date, which is only the first 2 months, is lower than 2024, but that's not indicating a downward trend. That's more of a seasonal thing. As more new vehicles come in and we get more redesigned vehicles over the course of the year, actually I expect that number to get up to 25% or higher by the end of the year. So we do have more new product coming in. Overall, there are 34 new nameplates scheduled to come into the industry, into the U.S. market this year, and that's double what we had last year and up from 22 the year before. On the other hand, it's worth pointing out from the affordability point of view, the mix of new vehicles coming in 2025, all new vehicles, is still skewed toward higher prices. 28 of them are battery electric vehicles, and most battery electric vehicles are what you would consider to be premium priced vehicles. And of those 34, 20 of them are even coming from luxury brands, or what you might say premium priced brands. So there's still going to be a lot of upward skewing toward higher priced vehicles. Now, there are 31 existing vehicles that are supposed to have major redesigns this year, and most of those are going to be gasoline only. And that number is really quite up a bit from what we saw over the last 2 years. So if the economy stays good and people are still interested in buying vehicles, that could have some upward momentum to overall demand, or at the very least keep vehicles more profitable for the manufacturers. Now, getting to the electrification part of the market, this is showing overall, the bars are showing total sales of battery electric vehicles and full hybrid and plug-in hybrid vehicles. And then the individual lines are showing the breakout between BEVs, full hybrids, and plug-in hybrids. So there's still been a lot of strength coming into this year overall. If they take away EV credits, that might put a damper on things over the rest of the year. But through February, I mean, for 8 straight months, we've had at least 1 in 5 vehicles sold in the U.S. has had some form of electric propulsion. A lot of the strength is still from last year is coming from full hybrids, which are surging. Even this year, through the first 2 months of the year, they're up almost 39% year over year. With EV credits still in place, and even the leasing loophole that is currently still in existence in the current policy, EV battery electric vehicles are growing for now, and they up almost 19% year over year. Plug-in hybrids, though, after a surge in 2023, which was really from a couple new vehicles that came into the market that added some volume to a low base of volume, they've kind of flattened out and still are a minuscule part of the market, roughly 2% of the market, and have been flat for a long time. Will probably stay roughly at that level for a while. So getting to the manufacturers then for this year. These are all production numbers for these manufacturers. I'm just pointing that out because when I get into the reasons of why production is up or down, I do talk about sales in terms of market share and so forth. So I just want to make sure that I clarify that the graphs and the numbers you're looking at are production numbers, even though I'm going to refer to sales and domestic and import mixes a lot. Looking at General Motors, which is the leader in the market, their U.S. market share in the second half of 2025 is not expected to keep sustaining the 17 plus market share they recorded since the middle of 2024. They had a big boost last year from a lot of new product that came online in the second half of the year, and that's a big reason why their production was up so high year over year. Plus, the year before, at the end of 2023, there was a strike, and that also made their second half 2024 numbers look a lot stronger on a year over year basis than they might have otherwise. But we expect them to still have a strong sales volume, but other companies start to catch up with them, and their inventory they're going to start gleaning some of their excess inventory. Their mix of import sales is also expected to increase slightly in 2025, although if tariffs, depending on what happens with tariffs, that we might change that outlook in a month or two. But another reason why their production numbers are not looking so good year over year is because they basically closed a high volume plant for a whole year that was building one of their biggest fleet vehicles, the Chevrolet Malibu, and then was also building the Cadillac XT4. So that's hurting production too. And just as an add-on, we do expect sort of a slowdown in share of their full-size trucks because they're getting kind of long in the tooth in their current product cycle. But they are due for a makeover, we should point out, in 2026, which should reverse that share slowdown. Ford, we see their production falling in the first half and then rising in the second half in a year-over-year basis. Overall, in 2025, we expect their market share and even their sales volume to drop, but that's mainly from the termination of the Ford Edge and its Lincoln sister, which were built at the Oakville plant in Canada, which has been closed for the entire year. So that's hurting their overall 2025 production quite a bit because they've lost an entire plant for the time being. They had a lot of new products reaching full availability in 23, 24 that have now kind of passed their peak, and short of them boosting incentives for those vehicles, we expect volume to start falling off for some of them. New Expedition and the Lincoln Navigator will boost production in the latter part of most of this year. And also in the second half, we see strong year-over-year gains because they were having some supply issues in 2024 that we believe will be smoothed out in 2025. Toyota, its market share is expected to rise slightly in 2025, but their mix of imports also increases, so that's going to somewhat limit their overall production gain in 2025 from 2024. They had a strong third quarter surge, or we were forecasting a strong third quarter surge and that's because the year ago quarter they had to stop producing two vehicles for the entire quarter because of quality issues, and that hurt their production as well as their overall sales in that period. And that's why you see that one big surge in the third quarter of this year. But overall, we still expect them to have a 2% gain year over year. Honda, we expect their market share to fall slightly in 2025 after big increases in 23 and 24. Volume will still go up, so production will still make a gain of about 0.5% based on forecasts. Honda sources about 98% of what it sells in the U.S. from North American plants. So even more so than some of the other manufacturers, its production tends to follow what its market share does. Stellantis, they've been undergoing a lot of inventory control lately because their market share has been tanking. And that combined, and we expect production, although we expect production to rise from 2024 quite a bit, but that's more because we expect them to get done with their big inventory correction. They do have some new product coming later in the year, which should reverse their market share, although not by a whole lot. But because they underwent those big inventory corrections, cutting production so much in the second half of last year, we still expect them to have some big year-over-year production gains in the second half of this year, although I would put more downside than upside to those big gains. Nissan, its production continues to fall in the first half of 2025 as its market share continues along its long-term decline. And now Nissan is really trying to cut its inventory too, or they'd been saying they were going to do that for a long time, and they'd made some attempts at it, but now they seem to generally be doing that. But market share is going to continue declining in the second half due to their aging lineup. They do have some redesigned products coming in the latter half of the year, which will help a little. But production rebounds more in the second half due to a comparison with a very weak year ago period when they were going through the motions of trying to cut inventory. The Hyundai Group, which includes all of Hyundai and all of Kia in these charts, market share is forecast to remain flat in 2025, but their sales volume goes up, so their production goes up, and we also see the mix of domestically made vehicles going up. They have a new plant that they're adding that's been added in Georgia, in addition to the one plant they already had going in Georgia. So that's adding North American capacity, and we expect production to look pretty strong there in each quarter of this year compared to the year ago period. Tesla, there's a lot going on with Tesla. If things keep continuing as it looks like they are right now on the political side of things and protests and so forth, there's probably more downside than upside to these numbers. We think price discounting was going to lead to a rise in their U.S. market share in 2025, and plus we expected a nearly doubling in sales in Canada in 2025 over 2024. So production was looking good. But as I said, I think some of that could be in doubt. There's definitely more at this point downside to upside to these numbers for Tesla in the U.S. and North America overall. Looking at the Volkswagen Group, which in their sales we include Porsche in the Volkswagen Group, but in production it's mostly Volkswagens and then an Audi in Mexico. But production weakens in 2025 due to expected sales declines in Canada and Mexico of its domestically produced vehicles. They have a high count of newer redesigned vehicles from late 2024 and into 2025, which you would think generally would help sales, but a lot of it is more along the lines of electric vehicles and a lot of overseas built vehicles coming from Audi. So production is we still think is going to decline about 4% this year from last year. And lumping the rest of the industry into one big number, last year this number was up, but now we've kind of revised it down, kind of along with the industry. Overall, we expect the rest of the manufacturers to produce 4% fewer vehicles in 25 from 2024. Lucid, Mazda, Rivian, and Volvo are the exceptions that are forecasted for gains. Lucid, the biggest increase right now but although they're probably the lowest volume producer among those. One reason why the rest of the industry is seeing a big decline, especially in the second half, is Subaru canceled production of the next generation Outback. It currently builds the Outback in Indiana. Next generation is coming out this year, but they're going to source it from Japan. And that cut a lot of production out of Subaru for this year and especially next year too. Rounding it out, BMW is forecast for flat year over year in 2025 on the production side, and we're expecting Mercedes to have a big downturn on the production side in 2025 from 2024. All right, then ending it with the brief 5-year outlook. This is the North America 5-year sales outlook overall for U.S., Canada, and Mexico. We expect it to be another 3 years before sales get back up to even the last pre-pandemic year of 2019. And 2019 was definitely quite a bit lower than the peak years we saw in the last decade. Share of domestically produced vehicles are expected to rise slightly after dipping to lows in 24 and 25. And as I say, I always point that out because that share of domestically produced vehicles is what drives production pretty much in North America. Tariffs could raise the penetration of North American built vehicles even this year, but that doesn't necessarily mean higher volume. If the tariffs lead the market for slower sales, it could mean we might see higher domestic penetration, but it could even mean that we still had lower volume of domestically produced vehicles, depending on the overall impact of the market that trade policy and other issues might have. Looking at just the U.S., this forecast incorporates fairly decent economic growth over the next 5 years. The forecasts incorporate economic outlooks from Oxford Economics. It's 2.6% average through 2027, and then it drops to about an average of 2%, which overall is not too bad through the end of 2030. But we still don't see sales getting back to the 17 million levels they enjoyed for much of the last decade. The reasons for that in general are the level of affordability is still going to be a headwind based on what we were used to pre-2020 for a multitude of reasons. Automakers are running with leaner inventory. We think they're going to continue that strategy even for the next several years. Aging population, and that people are on average are going to be driving fewer miles, so that's going to reduce replacement volume. And then vehicles on the other hand are also lasting longer, which also has an impact on replacement volume. Looking at U.S. sales of electrified vehicles over the next 5 years, I'll point out that these forecasts are as of December 2024. So it was before a lot of the turmoil we've seen for the last couple months really came in. But these forecasts were taking into account that there probably was going to be some sort of limits to volumes because of tariff activity. But I would guess when the next forecast comes out, which is going to be later this month, probably even, at least for electric vehicles, I wouldn't be surprised if the volumes were down. But currently, I will say we expect battery electric vehicles are forecast to overtake hybrids again about in 2027. And it's probably notable to point out that even in this forecast, at least 70% of the vehicles that are sold by the end of the decade will still have an internal combustion engine in them. And then quickly looking at Canada, as I already said, we expect growth in demand this year and even for the long term to be basically flat, and that's related mostly to economic sluggishness. Now, tariffs could have depending on how strong they are and even the retaliatory effects, if Canada lays heavy retaliatory tariffs on the U.S. and continues them, Canada will be heavily impacted even this year, and there could be a significant downward revision to their sales outlook for 2025. The same is true for Mexico, although it wouldn't necessarily be as bad as what might happen in Canada. Again, Mexico is seeing some strong growth this year after sales really tanked, even more so than the rest of the market. But we expect long-term growth there to be basically flat, again, based on some sluggish economic growth outlooks. But it doesn't have that much of an impact on production because only about 40% of what's sold in Mexico is built in North America. So lower sales volume, in a sense, isn't going to hurt production all that much. And then just to kind of end it where I began it, looking at the 5-year outlook for production based on where we're seeing right now, inventory control slows. It's going to slow production gains in 24 and 25, as already said. Keeping control of inventory, carrying less inventory overall, is going to cap production over the next several years, even though we expect sales to go. And production is going to remain more in balance with demand, another way to put it. But overall, we don't see production ever getting back, at least in this outlook, back to the 17 million levels that we once enjoyed back in the middle years of the last decade. So production we do see capping out at about 16.6 million by 2030. And so that wraps it up for me. I guess if we have time, we can still do some questions.
Absolutely. Thank you so much, Haig. First, if EV credits are eliminated, what's your view on the impact of sales of EVs and new product launches over the next 4 or 5 years?
I'm sorry. Yeah, Adam already alluded to that a little bit, but I think if the industry were to go to that extreme, just take the EV credits way, as well as that the leasing loophole, which has also contributed to a lot of electric vehicle sales volumes, especially with the imports. I don't. We couldn't really put a number to it, but I would say I would say over the next 5 years, it would mean a 50% reduction in sales of just
50%. Wow.
Electric vehicles, and the impact would probably be immediate. Mm-hmm. The percentage would probably be higher in the next 2 or 3 years, but maybe start to just as manufacturers started to were able to bring out more maybe cost-effective, more affordable electric vehicles if they continue, depending on how much they continue to invest in them for the U.S. But that, because it's a 50% production loss, also takes into account that we're going to see cutbacks in infrastructure, like not as many chargers being built. But a question that would push back a lot of the new product schedule and maybe eliminate a lot of those electric vehicle programs, would push them back probably into a lot of them into the 2030s or the next decade, especially plans for like non-premium priced or versions into the next decade from what versus what is planned right now. And we probably see some more investment, which we're already seeing now, but even additional investment back into ICE programs, even in the next 2 or 3 years. And then the other effect of it would be that we'd have to see some remixing of plant capacity, possibly some consolidation because of that.
Excellent. Well, Haig, I'm going to thank you so much for your time. Always absolute pleasure to have your insight. And that concludes today's presentation.